Hello everyone, so let's talk about the new rules that apply if you want to keep working while collecting Social Security retirement benefits in 2026. This is what people usually call the earnings limit, and if you've heard a dozen different versions of how this works, you are not alone, because this is one of the most misunderstood parts of Social Security. In this video, I want to walk you through the new 2026 numbers, explain when your benefits can actually be reduced, and answer the questions that trip people up the most, including what counts as earnings, whether your spouse's income matters, what happens to benefits that are withheld, and when all of these limits stop applying. And before we jump in, if you're new here, make sure you subscribe and turn on notifications, because Social Security rules change, the numbers change, and the way those changes affect retirees can be bigger than most people expect. A lot of people think Social Security is simple until they actually try to work, claim benefits, and coordinate all of that with taxes, retirement income, and timing. That is when the confusion starts. So my goal here is to make this as clear and practical as possible, because if you understand these rules before you make a move, you can avoid a lot of headaches later. Now, the way I want to approach this is simple. First, I'm going to give you the actual 2026 limits. Then I'm going to tie those numbers to real-life situations, because the numbers by themselves don't help much unless you know how Social Security applies them. And that's where most people get stuck. They hear one rule, assume it applies to every situation, and then months or even years later, they find out the Social Security Administration was looking at their case very differently. So stay with me through the whole thing, because the details are what make this finally click. The first thing you need to know is that the rules we're talking about here apply to Social Security retirement benefits. These are not the same rules used for SSI, and they are not the same rules used for Social Security disability benefits. Those programs have their own income and eligibility standards. The second thing you need to know is even more important. The earnings limit only matters before you reach full retirement age. Starting with the month you reach full retirement age, Social Security no longer reduces your retirement benefit because of how much you earn. That means the whole game changes once you hit that age threshold. So what is full retirement age? For many people, it falls somewhere between age 66 and 67, depending on the year you were born, and for anyone born in 1960 or later, full retirement age is 67 under current law. That's why you really do need to know your specific full retirement age before making decisions about claiming and working at the same time. A lot of confusion happens because someone hears a rule from a friend who is a different age, claimed under different circumstances, and had different timing. Social Security does not look at all of those cases the same way. Now let's get to the 2026 numbers. If you are under full retirement age for the entire year in 2026, the earnings limit is $24,480. If you earn more than that, Social Security withholds $1 in benefits for every $2 you earn over the limit. If 2026 is the year you reach full retirement age, the rule is more generous. In that case, the earnings limit is $65,160, and Social Security withholds $1 in benefits for every $3 you earn above that amount. But there's a very important detail here. In the year you reach full retirement age, Social Security only counts earnings received before the month you actually reach full retirement age. That last point matters more than people realize. Someone might look at their full year earnings and panic, thinking they blew through the limit, when in reality, Social Security is only focused on the months before full retirement age in that special year. And then once the month of full retirement age arrives, the earnings test disappears. From that point forward, you can earn as much as you want and still receive your full retirement benefit. That does not mean taxes disappear, and it does not mean Medicare issues disappear, but it does mean the retirement earnings test itself is no longer reducing your check. Now, one of the biggest questions I get is this: does Social Security look at your income by yourself, or do they combine it with your spouse's income the way the IRS often does on a joint tax return? For the retirement earnings test, the focus is on your own earnings, not total household income. So if you are receiving a retirement benefit on your own work record, Social Security is looking at your wages from a job or your net earnings from self-employment. Your spouse going back to work does not automatically shut off your own retirement benefit just because the household income went up. This is an individual earnings test, not a joint income test. But here is where that conversation gets a little more nuanced. If other people are receiving benefits based on your work record, those benefits can be affected when your own retirement benefit is affected by excess earnings. So if a spouse or a child is drawing benefits on your record, and your benefits are being withheld because you are over the earnings limit, that can have ripple effects for benefits tied to your record as well. and if your situation includes divorced spouse benefits or more complicated family benefit rules. That's where I strongly recommend confirming the details directly with Social Security rather than assuming the general rule fits your exact case. Another question that comes up all the time is what happens to benefits that are withheld? Are they just gone forever? And the answer is no, they are not simply lost. Once you reach full retirement age, Social Security recalculates your benefit to give you credit for months in which benefits were reduced or withheld because of excess earnings. In plain English, if you claimed early and then had checks held back because you worked too much under the earnings test, Social Security adjusts your benefit later so that those withheld months do not count the same way as months in which you actually received a reduced payment. That is an important distinction because many people hear withheld and assume it means penalty forever. That is not really what is happening. What is happening is more like an adjustment to the timing of your benefits. Yes, you can absolutely feel the impact in the short term if checks are held back, but the system is designed so that when you reach full retirement age, those withheld months are factored into a recalculation of your ongoing benefit amount. So the pain is real in the present, but it is not accurate to think of every withheld dollar as permanently vaporized. Let's make this practical. Suppose your monthly Social Security benefit is $2,000, and because of your work in 2026, you go $10,000 over the limit while you are under full retirement age for the whole year. Social Security would withhold $1 for every $2 over the limit, so that means $5,000 in benefits would need to be withheld. They do not usually nick your check here and there in tiny pieces just to make it feel gentle. In many cases, they withhold entire monthly checks until the required amount has been satisfied. That means you may see several months with no payment at all and then see benefits resume later. That leads right into another big question. Should you tell Social Security if you know you're going to be over the limit, or should you just wait and let them figure it out later? My advice is simple. Tell them. If you are under full retirement age, already receiving benefits, and your expected earnings change from what you originally reported, Social Security says to let them know right away. You cannot report that change online, so you need to contact them directly. It is much better to deal with the withholding up front than to drift into an overpayment situation and then start receiving confusing notices later on. And that overpayment problem is exactly why this matters so much. A lot of people assume, I'll just cash the checks now and sort it out later. But later can turn into a mess. If Social Security keeps paying benefits based on old earnings assumptions and then determines you should not have received some of that money, now you are dealing with recovery letters, explanations, and possibly years of back and forth. So even though it is not fun to call and report higher earnings, it is still the cleaner move. In most cases, the short-term annoyance is far better than the long-term paperwork disaster. Now let's talk about when the annual limit switches to a monthly test, because this is one of the least understood parts of the whole system. Social Security has a special rule that usually applies in the first year you retire. This matters because some people work for part of the year, earn more than the annual limit before they ever start benefits, and then stop or sharply reduce work later in the year. Under that special rule, Social Security can treat you as retired for any whole month in which your monthly earnings are low enough, even if your total earnings for the full year are already above the annual limit. For 2026, the monthly amount associated with the under full retirement age limit is $2,040 because the annual limit of $24,480 is divided by 12. So imagine someone works most of the year, earns well above the annual limit, and then retires late in the year and only earns a small amount in November and December. Under the special monthly rule, they may still be able to receive a Social Security payment for those whole months if their monthly earnings are at or below the allowed amount. This is one of those rules that saves people who would otherwise think they have to wait an entire extra year to receive anything. Now let's get to the question I probably hear more than any other. What actually counts as earnings? Because this is where people start throwing every type of income into the same bucket, and Social Security does not do that. For the earnings test, the main things that count are wages from a job and net earnings from self-employment. Social Security also includes things like bonuses, commissions, and vacation pay. So if that money is connected to your work, there's a good chance it matters for the earnings test. But a lot of income that retirees commonly receive does not count toward the earnings limit. Social Security says it does not count pensions, annuities, investment income, interest, capital gains, veterans benefits, or most other government or military retirement benefits for this purpose. Distributions from retirement accounts are generally part of the same conversation people misunderstand. Someone takes money from an IRA or another retirement account and assumes that alone will trigger the earnings test. Usually, that is not what Social Security is looking at here. They are trying to measure work earnings, not every dollar that hits your bank account in retirement. There is one more twist that can actually work in your favor. If you continue working while receiving benefits, those new earnings can sometimes increase your Social Security benefit later if that year turns out to be one of your highest earnings years in the formula. Social Security reviews earnings records and may recalculate your benefit if the new earnings lift your average. So working while on Social Security is not always just about avoiding reductions. In some cases, it can also help improve your benefit over time. That is another reason you want to look at the full picture instead of reacting to the earnings test in isolation. So the bottom line is this: in 2026, if you are collecting Social Security retirement benefits before full retirement age, the key numbers are $24,480 and $65,160, and the withholding formula depends on whether you are under full retirement age for the whole year or reaching it during the year. Your own work earnings are what matter most, not total household income. Benefits withheld under the earnings test are not necessarily gone forever. The first-year retirement monthly rule can help in the right situation. And the biggest mistake people make is assuming every kind of income counts, when, in reality, Social Security is mostly focused on wages and self-employment earnings. If you enjoyed this video, make sure you hit the like button and subscribe, because these are exactly the kinds of Social Security changes that can cost people money when they misunderstand them. And if you want, I can also turn this into a tighter YouTube-ready version with stronger hooks every 30 to 45 seconds, a more emotional retention pattern, and a cleaner outro that matches your channel voice even more closely.